Okay, so AI is everywhere, right? It's all anyone is talking about. But if you're a CFO, you have to cut through all that noise. The real conversation is about how we take this amazing technology and turn it into actual, measurable profit.
And that brings us to the number one question bouncing around every boardroom right now. It's a huge shift, you know? Everyone feels the pressure to get on the AI train, but the finance team's mandate is clearer than ever. Any investment has to show a real, verifiable return.
But here's the tough reality. A pretty shocking 95% of enterprise AI projects just don't meet their goals. For a CFO, a number like that changes the game. Suddenly, AI isn't a magic wand. It's a really high-risk bet.
And to make it even trickier, with all the buzz and excitement, the median return on investment that companies are actually seeing from generative AI is just 10%. Now, 10% might not sound terrible, but trust me, for most businesses, that number just doesn't cut it. See, most companies have an internal hurdle rate of about 20% to even justify the risk of a new project. So that 10% ROI, it's not just a little disappointing, it's basically a failing grade. And that is the gap we need to figure out how to close.
Which brings us to what we're calling the AI reality gap. It's this huge chasm between what the technology promises and what's actually showing up on the company's balance sheet.
And let's be clear, this crazy high failure rate isn't happening because the AI technology is bad. Nope, it's a failure of strategy, a total disconnect between all the hard work the engineers are doing and the real, tangible business value it's supposed to be creating.
So, how do we fix this whole mess? Well, we start by decoding the real cost and the real benefit of an AI project. We need to start speaking the language of finance, not just the language of tech.
Now, while ROI is obviously important, the payback period is, for my money, the best metric for sizing up the immediate financial risk. It answers one simple, crucial question: how long until we get our money back? For smart financial planning, you're really aiming for something in that 4 to 6 month sweet spot.
Let's make this super concrete. Say you invest $100,000 in a custom automation tool, and that tool winds up saving your company $250,000 a year. Well, you just divide the investment by the savings, and you get 0.4 years. That's a payback period of less than 5 months. Everything after that, that's just pure profit hitting the bottom line.
But here it is. This is where so many companies get it wrong. That initial investment number. It is not just the price tag. It absolutely has to include the total cost of ownership. We're talking about all the hidden costs: development, training, maintenance, infrastructure, the whole shebang. Forgetting TCO is how projects go off the rails and budgets get completely blown.
So this brings us to what I think is the most powerful tool for digging up real value. It's called the So What test, or if you want to be formal, the double-click framework.
You know, the really successful companies use a bunch of these advanced frameworks to measure value. But for today, we're going to zero in on the one that is absolutely essential for any CFO, and that's a double click. The whole framework kicks off with this simple but relentless question. A department head comes to you and says, "This new AI is saving us so much time." The CFO's response has to be, "So what?" That simple question forces the whole conversation to shift from some vague idea of efficiency to a specific dollar-based impact.
So here's the first double click. You take that abstract concept of time and you turn it into cold, hard cash. For instance, let's say an AI tool saves 500 hours a year for an employee who costs the company, say, $60 an hour all in. Boom! The direct savings from that first click is $30,000. That's a real number you can put on the balance sheet. But the real magic is in the next step.
The second and final double click asks the most important question of all. What actually happens with those 500 hours you just got back? I mean, if they just kind of disappear into longer lunch breaks, the value is pretty limited.
But what if that employee reallocates those 500 hours to, say, strategic client outreach that actually generates new business? Well, now you've connected automation not just to saving costs, but to growing top-line revenue. And that is the absolute holy grail of AI ROI.
Now, understanding value this way leads you directly to the next huge decision every company has to make. Do you buy an off-the-shelf AI tool or do you build a custom one from scratch?
At first glance, off-the-shelf software looks cheaper, right? But the total cost of ownership is often way higher because of those recurring per-user subscription fees that basically punish you for growing. Custom software, on the other hand, costs more upfront, but its TCO is lower over time. And get this, for companies with over 500 users, it can deliver a staggering 300% higher ROI because it's built to perfectly fit your specific workflow.
So let's pull all this together. What does a smarter AI investment strategy really look like? Well, it's not about just throwing money at shiny new things. It's about being disciplined with how you allocate your capital.
A lot of financial experts recommend this 30-40-30 model. 30% of your AI budget goes to process automation, the quick wins that give you immediate savings. The biggest piece of the pie, 40%, is aimed directly at revenue growth. And that last 30%? That's for risk reduction, automating things like compliance and security, where the ROI is measured in the disasters you manage to avoid.
All right, here's your playbook to get started. First, go find your top 3 most manual, time-sucking workflows. Second, calculate exactly what those old processes are costing you right now. Third, run a 5-year total cost of ownership analysis for both buying a tool and building a custom one. And finally, go talk to an expert to scope out what's really possible.
And I'll just leave you with this one last thought. Your company is already investing. It's investing heavily in the high cost of manual labor, in human error, and in just plain inefficiency. So the real question isn't whether you should invest in AI, it's whether you're happy with the return you're getting from your current investment in doing things the old, manual way.